Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back here on YouTube and we're looking at the SPY today, which is our proxy for the S&P 500. So, we're above previous all-time highs and continue to climb higher. We called the lows back in April of this year and it's been a very profitable rally since. The rally has been actually incredibly strong. And my overall gauge and my overall feeling towards the sentiment of this rally is that a lot of participants have had one foot out the door ready to leave at a moment's notice, and half of the people who could have gotten in never have. So although we've gone to new all-time highs, it's not been a particularly well-liked rally. In fact, in my experience, it's been one of the more hated ones. And for as long as it's, in my opinion, for as long as that sentiment prevails, there's no reason for the market to correct. Now, on that note, I should point out that there hasn't really been any. There hasn't really been any corrections at all since this rally began. Nothing greater than 2% for a while now. So this leads us to certain conclusions, or, well, I won't say conclusions, this leads us to certain possibilities regarding the Elliott wave count. We will come in and talk about that later. Well, I wanted to start with the classical analysis first. So, we're going to start here on the day time frame. We're going to move around a little bit. We're going to look at a few other indicators I'm going to bring up in a little while. And we'll try and get a feel for what's going on from a classical analysis point of view, because there is some conflicting and contradicting signals, perhaps leading into one of the reasons why the sentiment is so at odds with what's been going on. But I think that's often the case. You know, they say that bull markets climb a wall of worry, and I feel that's what we've been doing for a while now. So let's bring up our exponential moving averages. We can see that on the daily time frame we're above the 10, the 20, 62, 50, all of them pointing up after the correction in April. Yes, they are lagging indicators. They follow the price by a set delay interval. So they're of course not going to give us a clue as to whether or not the market is about to roll over, but they will help us confirm when it does. As we can see, the 10 and the 20 came through the 260 the 60 exponential moving average through here, remained below it until they passed through the 250, and then once the rally was over and everything started pointing back up and we started rallying, we will have leading indicators as well, which gives us an idea as to whether or not the market's bottom. We'll have leading indicators as to whether or not the market is topped. These moving averages are what we call lagging indicators. There are also coincidental indicators. Coincident mean that they happen or they confirm at the same time as the market ticks. Either way, an overall very bullish look on the daily time frame. If we bring up a few indicators here, I'm just going to shut down these ones, we'll have a look at those later. We've got our RSI, our MACD and our OBV. So we can see how there has been on several occasions throughout this rally. We look at the RSI for a moment. Since the low in April, we can see that we've had periods where we've been forming lower lows, or lower highs I should say, on the RSI, and during that same period we have been forming higher highs in price. Okay, this is what we call potential bearish divergence. It was never confirmed bearish divergence. Lower highs in RSI and higher highs in price is divergence between the current price as it was at the moment we observed the divergence compared to the previous high. It is not confirmed bearish divergence unless a pivot occurs. A pivot is a clear reversal in place, a clear shift in momentum, a clear bearish signal of a change of trend. So none of that occurred, and therefore the market eventually wiped out these divergences and moved to new highs on the RSI. We saw it form again here, but then we came down, cooled off a little bit below overbought conditions, and then now we're back at overbought conditions again. So we are getting a little overdone in price, but there is no longer term divergence between prior highs and current price. So there's no significant weakness in the RSI here suggesting any imminent pullback. So for the moment the market still looks pretty strong. Now on the MACD however we get a different story. We can see that since the momentum really kind of peaked back in May, we've been setting a series of lower highs on the MACD while the market has been moving to higher highs. So we've got a contradiction between the RSI and the MACD. Now the thing is, I'd argue that the RSI takes precedence on this time frame because if what I suspect is happening, the reason we're not seeing higher highs in the average and line signals here on the MACD is because the volatility is so suppressed. We're not getting any oscillation in price. Prices pulling back 1% or so, then rallying, pulling back 0.5% or so, rallying 0.5% or so, and rallying. We're not getting that whipsawing movement, that shifts in momentum, which tend to show either very bearish MACD or very bullish, and we're just kind of trundling along, stepping up this wall of worry, so to speak. Now on the OBV, however, we continue to set higher highs, so cumulative volume on the daily time frame, even since the prior highs back in December 24, continues to march higher, confirming what the RSI and the price are confirming, which is the market is still in a strong and stable condition, still seeking higher highs. So generally, the MACD is at odds with these two, but it's 2 versus 1 at the moment. And given the overall price structure is intact, the trend is intact, higher highs and higher lows, you have to still be bullish at this point. Now, there's a caveat to that, which is we are overbought, and therefore some kind of call off can occur at any moment. But as we've seen, we've been overbought before, and still, even on weakening RSI, still continued to climb. So being overbought is not a guarantee that the market's going to reverse at all. Even bearish divergence on the daily time frame is not a guarantee that the market's about to reverse. You cannot become bearish until we see a clear weekly time frame pivot in place. I would argue, given the strength of this trend, that's what we're going to need. We're going to need a weekly bearish engulfing candle. We're going to need a close through major moving averages. We're going to need to break the current trend, and then we want to see on the smaller time frames confirmation of that via divergence, weakening the OBV, weakening the RSI, weakening the MACD, and none of those things are present yet on the daily time frame. So this hated rally looks set to continue for the meantime. No guarantees, there's always something potentially out there waiting in the unknown, but for the meantime it looks like it wants to just continue crawling and continue climbing. Now when we come out to the weekly time frame, we can see that the bearish divergence, which was showing up all the way back from March 24 into the highs of July 24, so if we go back to here, we can see here's March 24 back here. We had bearish divergence into the highs of July. This is on the weekly time frame. We had bearish divergence into the highs of December 24. We had bearish divergence continuing 3 times over into February 25. Then we had this correction. So on the weekly time frame, you can see that the weakness here on the MACD and the weakness here on the RSI took many months to build up before we had this correction. So between the prior high and the current price, not a confirmed high, but between the prior high and the current price, we can see, if we line it up on the MACD here, we can see between this high and this high, there is no sign of divergence. This is because of the swing into negative momentum on the MACD. Same here on the RSI. If we were to take the same line from the previous highs and bring it to the current highs, you can see there's no bearish divergence on the weekly time frame. We've come down to oversold on the weekly time frame below the 60 exponential moving average, and we've moved all the way back up to overbought on very strong momentum. In fact, the momentum on the weekly time frame off of this rally in April has superseded all of the strength we've seen in the market all the way back to COVID. I think we have to go back to find that kind of histogram behavior. In fact, the current rally supersedes even the V-shaped recovery off of COVID. A lot of this does support the idea of it being a very hated rally, strangely enough. It's under these circumstances where liquidity continues to find its way into the market. There are enough people sitting on the sidelines who are gradually getting in that this thing keeps crawling higher. It's only once everyone's in that's going to be in that will peak, that will top, and then people will start selling, and the selling could be quite aggressive. But for the moment, we keep treading water, right? And we can see that the OBV on the weekly time frame shows some bearish divergence between prior highs, but continues to rally off of the April low. Meanwhile, both the RSI and the MACD are significantly stronger than the prior highs. So for the meantime, no sign of weakness here in the weekly time frame either. So next thing I want to talk about is a couple of indicators. So we're going to just quickly bring up the, going to close these down, and we're going to bring up the ISM data from the report of manufacturing. So this is from the Institute of Supply Management, and we're looking at the report on business for manufacturing. So if we just zoom out to the weekly time frame for a minute, you can see historically, I'm going to give you a lot of space here. These are the business cycles. Okay, so the green line represents the 50 bound. If you're above the 50 bound, then the economic activity is expanding in the manufacturing sector. If you're below it, it's contracting. The rate at which you're above it is simply the acceleration. So if you're at, for example, if you're at 56, then the manufacturing sector is expanding. If you're at 50.9, the manufacturing sector is still growing, it's still expanding, just at a lower rate. So that's what it determines. Now, we've been below the 50 bound continuously for a long time, since basically we dipped below it back in October 22 during this correction here in the stock market. We came down from highs of around 65, I think, somewhere around there. And then we came all the way down into contraction, and we've stayed in contraction consistently for the last few years. Okay, since October 22, we've failed to get the business cycle going again. And the business cycle tends to be very, predictable. It's not perfect, but it generally oscillates pretty evenly over time, as you can see. Right, this is a more extended period where we've been below 50 bound. So what I'm pointing out is that the market has rallied continuously, and it's been a very strong rally, even though the business cycle has not gotten going. And normally the two are in sync. Market is rallying, economic conditions, manufacturing sector is growing. Market rallies, manufacturing sector is growing. Market contracts, manufacturing is contracting. Tends to peak prior to the market as well. This is an oddity. Since the lows of October 22, not just the lows of April 25, but since the lows of 22, the market has rallied strongly and continues to do so, while the business cycle has failed to even get into growth. It's been contracting the whole time. Now, there's something else here as well. Well, I want to point out, which is a bit of an oddity, and why I think points towards even the rally off of the 22 lows being so unpopular, is because it's conflicting with traditional sentiment. It's conflicting with what we'd expect to see. And on that note, let's come over to this chart here. So this is from the University of Michigan website. They carry out the consumer sentiment surveys each month. If you don't know the website, you should go and look it up. University of Michigan Consumer Sentiment Survey. Go type that into Google. It's a free website. There's loads of useful data there you can look at. Here's 50 plus years of consumer sentiment. And as you can see, the low over where my little cursor is, if you can see it, this is the 2022 lows around October, where sentiment was absolutely on the floor. Okay, obviously we've got this little grey line here represents COVID recession. This big grey line here represents the GFC. So this line here represents the tech bubble bursting and the post-recession. So in other words, the little grey lines represent the recessions throughout history. As you can see, boom and bust was a very regular activity, recessionary behaviour, drawing throughout the 1960s and 70s. We have the fiat currency world come into existence in the 1970s under Richard Nixon with the breaking of the gold standard, and then we tend to have these sustained periods of economic growth with smaller recessions which are further apart. Whether or not that's related, I don't know. This is most likely the technological boom, continuing technological booms, from obviously engineering and manufacturing to microprocessors, the internet and beyond, and now AI and all that kind of stuff. But we can see the economy last reached extremely high sentiment just before COVID. COVID absolutely annihilated it. As we know, we gutted the global economy and we reached all-time lows in the consumer index. We haven't seen these kind of lows since 1980. We've recently double bottomed in consumer sentiment, with the July reading around June reading also around 51, 52. Okay, we've bounced back a little bit in July, but we're very, very low. Now, historically, if I show you on the chart, let's bring up the consumer sentiment from the University of Michigan. So if we zoom out now and have a look at sentiment over the long term on our little chart here, we can see that generally, as a general rule, The lows in the market, there or thereabouts, represent very low readings in consumer sentiment. Okay. Now this only goes back to April, the latest data, as opposed to the website which goes to July, so just bear that in mind. But you can see generally consumer sentiment tends to support the trend in the markets. Right, people feel more confident about the economy, the stock market tends to represent that. We have a low because of COVID, here we have a breakdown in consumer sentiment, right? The market from COVID onwards broke this historical relationship. The market rallied because of all the free money out of COVID, while consumer sentiment actually went lower. And it actually reached its lows in 2022 around this dip in the stock market. Since then, the stock market has gone on to higher highs and continues to rally strongly. Consumer sentiment has come back to a double bottom, even though the market's rallying. We see even the July reading is still in the low 50s. Okay, and this is happening at the same time as the business cycle is just not getting going. So one of the peculiarities is that the market has rallied when there's very little psychological participation in that rally and reason to actually support it. People still feel very down about the economy, and purchasing managers in the PMI, Purchasing Managing Index, on the Institute of Supply Management Report on Business and Manufacturing, there's a bloody mouthful, feel the same way. They're not particularly confident either, and the market and the manufacturing sector is still in contraction. Why am I labouring all of this? The reason I'm labouring all of this is either this is all a fake out and it will eventually come down to catch up with what we're seeing in reality, or, and this is the side I'm leaning on, and I'm not saying it has to be this way, these are tailwinds which have yet to catch our sails. Right, what do I mean? What I mean is we are setting higher lows in the business cycle. It is starting to creep above, it's not above 50, but it's going to creep above 50, I think, and we're going to get there in the next few months. And then I think that the business cycle is going to expand, and I think that consumer sentiment is going to improve. And then I think that the narrative behind the stock market rally, we may have a pullback, that can happen at any moment. Right, but I think the longer term sentiment is price is going to continue to elevate, but eventually there'll be a reason for it doing so. And all of the money sat on the sidelines, looking at the negative sentiment, looking at the weak business cycle, looking at the high interest rates and Fed policy at the moment, are like, oh, I don't really buy this rally, blah, blah, blah. All of that's going to disappear when these indicators improve. So what's been suppressing the business cycle? I think it's pretty obvious, isn't it? It's rates. Rates are too high. The bond market has been going sideways for years. Yields remain elevated. And the Fed remains strict with their no-cut policy for the meantime. We are now starting to talk, and the market is now anticipating with over 60% odds cuts in September. Pretty much no chance for the meeting to this month. I think this sentiment is going to improve. So I think we're going to get rate cuts. Business cycle is going to improve as a result of those rate cuts. Consumer sentiment is going to improve as a result of those rate cuts. The market's going to continue to move higher. And then eventually, as the economic easing process continues, money supply continues to expand, rates start to come down, because the bond market is going to drive real rates anyway. And I think the bond market has been looking very toppy for a long time. I've been a long-term buyer of the lows in the bond market because the yield's attractive to sit on and just collect the coupon, but in the meantime it's also a case of or the dividend in the case of ETS, since I'm not an American citizen, then it's just a case of waiting for things to reverse. So that's an awful lot of waffle. Sorry to go on so much, guys, about the classical analysis, but I just wanted to give you some insight into the macro views I have at the moment. I feel that the business cycle has been very stagnant because of the instead of the relatively low rate interest rate policy we've had since the GFC back in 2008, the swing back and forth from tightening and relaxing, tightening and relaxing. Ever since COVID came along, we've just been tightening, right? We've just had that. We've still been producing money, but we've had that tight interest rate policy. That's suppressed the business cycle, but that will change as rates come down. Consumer sentiment's on the floor because of the cost of living crisis, high prices, the knock-on effects of the inflation post-COVID, but this will improve as borrowing gets easier and rates get lower. all the money that can find its way into the stock market under these very pessimistic conditions is finding its way in, but there is still the general public and a lot of institutions. The institutions have one leg out the door in a lot of cases and they're not fully committed. Some have even been consistently adding liquidity to the market by shorting it. And then you've got the general public who aren't even here. I don't feel. They're all going to be arriving if economic conditions improve. So we could be looking at a melt up. I'm not saying it's going to happen. It could be completely opposite. I'm just saying the environment, in my opinion, is in the correct circumstances to surprise everyone and blow everyone's head off and actually melt up in the coming months. But we'll see. I could be completely wrong. It's just a hunch and I thought I'd share it. So anyway, that concludes our classical analysis and we'll now come and talk about Elliott wave stuff. So here we are on the 4-hour chart now. Going to bring up our Elliott wave count. So we're going to start with the primary. Now there's I would argue, little more than a thin butter knife between the primary and the alternate counts, because, as I've said earlier, Elliott wave confirms itself via its corrections. It's all well and good the market just doing this, but it's not until it does this that we go, oh, 1 into 2. The market does this, and it's not until it does this that we go, oh, 3 into 4. You see what I'm saying? It's the corrections which give away the wave degree you're in. It's the corrections which give away the scale of that wave degree, the extension within, and all the other clues. If the market doesn't pull back, it gets very difficult with these little 2% pullbacks to start counting the waves in any meaningful manner. So we end up just extending the count on all of these small little pullbacks, and that's what we've got here. So this is the idea of a fifth wave extension. That the first major pullbacks, the only major pullbacks, and I say major very loosely, it's in context of having barely any. We come back here 1 into 2, we come up to here 3 into 4, okay? And now we're in a fifth wave up. And this is 1 and 2, this is 3 and 4, and now we're looking for 5 waves up into a fifth wave at minor degree, into an intermediate 1, and then a significant breakdown into 2, a pullback. Now, obviously, everything I've just said, which sounds very bullish in the classical analysis section, if you were to pile into the market now and have this significant correction pretty soon after it started or a few weeks into it, you're going to start thinking everything I said was wrong. But pullbacks happen and they have to happen. They're buying opportunities. And all of the money on the sidelines will be looking for this opportunity. Okay, and that is what likely, along with improving sentiment and rate cuts and the rest of it, over the macro time frame, months into quarters, quarters into years, not short time frame, we could see that melt up circumstance continue and the market really start to explode higher, and this 1-2-1-2 count completely supports that idea of an extended wave 3 going higher over the longer term. So that's the primary count. No sign of a pullback yet, no sign of reversal yet, no bearish signals on the daily time frame and above on our RSI or on our OBV, some weakening momentum on the MACD as we discussed, but no clear way, no point saying this is the top. There's just no point saying that. Until you actually get a signal in place, we're just going to assume the trend is intact, and while the trend is intact, the trend's your friend, blah, blah, blah. So there's the primary. Now the next one, alternate 1. What if that pullback never comes? What if the money on the sideline doesn't get the opportunity to buy at a discount? What if it's forced to participate against its will? What if it's a case of use them or lose them, get in or you can never get in, right? That will create a melt up scenario without a correction. Like that will create a scenario where we have 1-2, 1-2, 1-2, 1-2, 1-2, and there are going to be no more pullbacks. Now the advantage of this count, although it is still just considered an alternate, is it invalidates itself sooner. If we're assuming yet another 1-2 at a smaller wave degree, then we can set a couple of parameters around that. We can say, well, what's our deepest correction we've had? Okay, we've had a correction here of 3.3%, and this correction took in time 4 days, right? We haven't seen a correction of that magnitude in depth, or at least both deeper and longer. We've had one that's longer, but not one that's deeper. Okay, so if we were to suddenly have a significant sell-off, like I said, a reversal on the day time frame followed by a weekly reversal candle, bearish engulfing candle, shooting star, something like that, a rollover, a sudden increase in selling volume, a rollover of momentum, a off the back of shorter term time frame divergence on the RSI, all the bearish signals are in place, and we break the trend of higher highs and higher lows, we can say, well, this is wrong because that 2 can't come back beyond where the 1 began, and so this 2 can't come back beyond this where this 1 began, and we can say, well, actually this is highly unlikely given the depth of the correction, the strength of it, the time frame of it, far more likely that this extension wave 3 count is completely wrong, and we can delete this. But if the market continues to climb or even starts to accelerate, this gets stronger and stronger every day that it does in terms of it being the correct count. It seems pie in the sky, but I've already explained in the earlier segment of this video. If you came straight to the Elliott wave bit, this one you should probably watch the whole thing, go back and watch it. I've already explained how the sentiment could be there to drive the kind of circuit of this kind of count. And then finally there's the possibility, I know there's a lot to talk about today, it's just like I said, the market's not giving us anything clearly to work with, so we have to just look at all the options. There's a possibility that we've already done 1, 2, 3 and 4. As I mentioned, we're in the 5th, but instead of extending, we've got a long-winded expanding diagonal in play. There is no upper limit to the legal finish for this thing, but we would expect it to respect the geometry of the 1-3 trend line. It is quite uncommon for the wave 5 to even get to it, let alone breach it. It will breach it in a contracting leading diagonal or ending diagonal, but it won't breach it. Very rarely will it breach it in an expanding diagonal. That line tends to be out of reach. So we would be looking for weakness into the highs. As I've said, it's not there yet. Alright, but this could be the count as well. Brilliant, Tom. So we've already got 3 possible bullish counts, but they're not dissimilar. The primary and the ending diagonal both suggest we're in a 5th wave, which will top out sooner or later. Only the extended count, alternate 1 as I'm calling it here, suggests that we will rocket higher from here. Then there's the bearish idea. So this assumes that the crash down into April of this year was not a completed correction, but simply the beginning of one. And what this means is that the market crashed down into April as a 3-wave structure. The market rallied as a multitude of zigzags into new highs, into our target box between the 89% retracement of the wave A and the 1618 extension of the A. This is the cutoff point for a B wave of a flat pattern. So we could come all the way up to 694 spot 94, let's say, 3 down, 3 up, before having 5 waves down and a massive crash. And that would take us below the April 25 lows if this was the case, because regular flats and expanded flats come below where the A finished. The C completes beyond the A. Only running flats complete before it, and they're less common. One might even say rare. So this is the bearish idea, and you might say, well, this is a very large target box, Tom. Yes, it is. If there was significant bearish divergence, and there was for a while, or clear signs of reversal coming, we could maybe shrink this, but there are no clear signs of reversal. There is no sign that this market's giving up, and therefore the cutoff is all the way up here at 694 spot 95. So once we get above that, we can at least say, I know it's a long time away potentially, but it doesn't have to be, we could say there's no way this is bearish if we go above that high. It's all bullish off of the April low, right? Bit bloody late to be getting into the market, mind. This is why we called the low back in April, because we wanted to be taking part in this thing, not watching it. And then finally, there is the idea that this is all the way 4 into April. If we have to come back a little bit further now, I know you're probably thinking, God, there's too much to think about. Problem with the market not giving us a pullback. This is the idea that we came up in 1 and 2 sideways, flat correction. Then we came up into 3, sharp correction, alternation in corrective form between the wave 4 and the wave 2. Not a prerequisite in Elliott wave, but it's something that's nice to see. But there was extremely deep, come back to the 50% retracement, and it's a sharp. Sharps are more common in wave 2s, and 50% plus retracements are more common in wave 2s, hence why that's the primary count. But this suggests that it's actually a very rare, well, not very rare, but a rarer wave 4 sharp. 1, 2, 3, 4, and now this is the 5th. We're right back above the wave 3, as our expanding ending diagonal count calls for, as our extended wave 5th count calls for, which is 2 of the bullish counts, suggests that the market could top at any moment. Right, but we don't know. But this is a possibility if the market does top and we get a reversal signal in place. So, sorry to keep you guys going back and forth so much, but let's now summarise. So, primary count and the one we're going to focus on in the meantime. Okay, we're in a fifth wave extension within a larger wave 3, looking for the completion of intermediate 1. Sooner or later, this 1, 2, 3, 4, 5 wave structure is going to top out and we will have a more significant correction. We will be looking for signs of reversal consistently as we progress further in time. Okay, and we'll be anticipating a high to come. We won't be shorting it before it happens. We won't be jumping off of rooftops or panicking. There's no sign of it yet. Okay, next one. We're not getting a pullback. End of story. Right, we're in a wave 3 extension at multiple wave degrees, and we are the reason these are getting smaller in percentage and smaller in time frame is because they are smaller wave degrees. Subminute, minuet, minute, minor, intermediate. They get smaller and smaller in magnitude and time frame because they are smaller waves. This supports the idea of a melt up being imminent within the next few months, next few weeks, and next few months. We will be looking for the opposite. To confirm this one, we will be looking for a breakout in the MACD. We will be looking for continued strength in the RSI. We will be looking for continued push in the OBV. We will be looking for the longer term macro sentiment indicators of the ISM manufacturing report on business and the university sentiment consumer to start to continue to improve. We will be looking for the narrative behind this to be supported behind the idea of cutting rates and the Fed announcing rate cuts and the tailwinds which will come with all of that. That's the evidence we'll be using to support this count going forward. This will invalidate itself sooner though. If this upward trend of higher highs and higher lows breaks and any subsequent correction results in bearish pullback which breaks this upward trend and is larger in magnitude and time frame than any of these prior corrections, we can say this is wrong. Brilliant. Where is it? Ending diagonal, same idea as the primary. It will top out as a wave 5 and it will respect this wedge shape. It won't go above that top line. Most likely. It's not impossible. It will likely find its high sometime very soon. And then it will roll over, similar to the primary count. Bearish count, where all of this is B wave and it could reverse at any moment. If it does, we'll be looking for signs of weakness again. Okay, and then finally the idea that we are about to top. It's basically the same idea. You see what I'm saying? We're going to top out on 3 out of 4 counts. Okay, or we're going to explode higher. Right. So we'll see. But I'll try and be there when it happens, guys. Obviously, I'll update my patrons first. I give them a weekly update on the SPY, Bitcoin, and gold every week anyway, so they'll know roughly when I know. So now let's have a quick look at the PCC. Put the call ratio. We can see that long term, right, we continue to drift downward. We had extreme bearish sentiment around October 23. We had extreme bearish sentiment around from June 22 all the way through to January 23. Very bearish period as the market was selling off. Then we came down in July 23, came back up into October 23, and now since then the market has been drifting from extreme fear and bearishness towards extreme complacency and bullishness. We're not right down near the lows yet. The lows is in the highs of the market normally, right? So the PCC lines here, these yellow lines, they are on the SPY chart. I have a template which shows them on the SPY chart, and the correlation between the market reaching extreme fear and the market and the stock market, the PCC reaching extreme fear and the stock market reaching extreme lows, is extremely good at predicting those lows in the market. Obviously no sign of lows in place at the moment. Opposite, we're looking for the highs, right? The highs are harder to predict, but the really long-term highs tend to come when the market is in a state of extreme complacency and bullishness. It's not in extreme complacency yet, but we've been heading consistently towards that direction. A blow off top, a melt up would bring us down into here, and we would likely be here for a while as well. Okay, so that's the put the call, heading in the right direction to support the rally. The next thing we'll talk about is the VIX. Let's have a look. There we go. So I mentioned earlier the lack of oscillation on the MACD, right? There's no swinging in momentum from green histogram bars to red histogram bars, average lines, signal lines crossing regularly back and forth. None of that's happening. We're just treading water. It's because volatility is so suppressed. Down below 15 at 1470, and very little movement since the last big spike we had. The last big spike we had was the tariff/trade war panic. This is when we called the lows back in April. We saw the spike in the VIX, we saw the spike in the PCC, we saw the oversold conditions on the weekly time frame. We said very likely the low. Very likely the low because everyone's panicking. You could try and think back now to the narrative around the Liberation Day tariffs and everything, and just how everyone was losing their fucking minds. Trump's going to ruin the economy, the whole world's going to be over, oh my god. It's never ever that bad. It's just the media wants you to be terrified. And they want to just feed you endless piles of horseshit. And that's exactly what we were getting fed back here, which is a very clear sign that the lows were probably in. Right, now volatility is being very suppressed and continues to get more and more suppressed. Right, so if anything, we should start not anticipating a high, but we should be on alert for it. We should be saying, let's pay attention, we're overbought, we're pushing higher and higher, we should probably have a pullback. Odds on, like 3 out of 4 counts we've got are pointing towards there being some kind of pullback. But we're going to finish today by talking about the outside chance that there is no way of getting back into the market. There is not going to be a sell-off, and it could be a melt-up. Now that melt-up could come in after that sell-off, which is what would be ideal for all of us to add to our positions, but there is the outlier that we're just going to explode higher. So we will wait and see, guys. It's been an interesting few months. Like I said, we very rarely throughout history see such a divide between sentiment, manufacturing data, economic data in general, and the stock market. The two don't have to be in tandem, but they often rhyme. So we're going to leave it there. Thank you very much for joining me. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn Elliott Wave for yourself, plus a whole bunch of other technical analysis skills and stuff as well, and get access to years worth of educational material, a public Discord where people can share their ideas, and regular weekly updates for the major markets, as well as asset requests which I'll answer and look at in videos as well, then feel free to sign up to the Patreon. There's a link in the description box below. Take care of yourselves, guys. I'll be back with you as soon as I can. All the best. Bye bye.